Welcome to Learn Commerce PU online classes. Don't forget to like our video and subscribe our YouTube channel for all the updates.
Hello students, welcome to second PUC Accountancy online classes. Students, in the previous class we have solved all the problems of 6 marks, right? Now let us move on to 12 marks problems. Page number 123, problem number 12. Problem number 12. Yes, I will read out the problem, 12 marks problem, so there will be more number of ratios they will ask, isn't it? I'll read out the problem, let us analyze and we'll solve the problem, okay? Yes. From the following information, calculate debt equity ratio, proprietary ratio and debt to capital employed ratio. Yes, debt equity ratio means debt to equity. Equity means shareholders funds. Shareholders funds includes everything, that is equity share capital, preference share capital, then reserves and surplus. If there is a profit and loss account, there is a balance, there is a balance of statement of profit and loss, isn't it? Or any other fund which belongs to the shareholders. All this will come under, that is a shareholders fund. So here debt means long-term debt in the sense debentures, long-term borrowings, all this will come under debt. Equity, I already told you, that is shareholders funds, isn't it? Then proprietary ratio is nothing but shareholders funds divided by capital employed, friends. Capital employed means total of assets or total of liabilities, that is a capital employed. That is if we take the total assets, that is nothing but capital employed. Or if you take the entire, that is a total liabilities, shareholders funds, non-current liabilities and current liabilities, that comes that together will be called, there is a shareholders, there is a capital employed, isn't it? So that is the other ratio we have to calculate. Then what the debt equity ratio will suggest, that is a capital structure mix, isn't it? Capital structure of the business, that can be known how much debt fund is used and how much, that is equity fund is used, because you know that is a difference, isn't it? Equity fund and debt fund. Debt fund in the sense that is borrowed fund, equity fund in the sense that is owner's funds. More you use equity funds, then what happens? The profit that is earned will go as a dividend to shareholders, isn't it? More you use debt fund, that is a debt service charge will increase. Suppose the company is bumper profit making company, we declares higher rate of dividend, then equity will be costlier source, because you have to pay at a higher rate. Dividend should be paid at a higher rate, isn't it? If the company is earning normal profits, then debt fund will be better, it will become cheaper. Is it? No. You need not pay the dividend in that case. If there is normal profit or there is no profit at all, then you need not pay the dividend, because payment of dividend is not compulsory. If there is profit, if there is more profit than dividend, the shareholders will demand, isn't it? Otherwise if there is no profit, no question of payment of dividend. So equity will be cheaper source of finance if the company is earning normal profits, or that is incurring losses or no profit at all, isn't it? In that case, equity will become the cheapest source of finance. Debt will become costlier because it has fixed interest charge. We have to pay interest on the debt borrowed. So there will be fixed liability on the debts. So we have to choose depending upon the position of the company. We have to choose which fund is suitable for us and which is the cheapest source of finance, that should be known. Coming to here, proprietary ratio and debt to capital employed ratio. Debt to capital employed ratio in the sense that is total debts, long term and short term both, total debts divided by total assets. Total assets or total liabilities, makes no difference. Total assets, isn't it? So that is what we have to calculate here. Let us solve the problem. Let us see what are the items that are given. Equity and liabilities, shareholders funds, under that share capital, reserves and surplus comes under shareholders funds. Non-current liabilities, that is long term borrowings, current liabilities, isn't it? Then non-current assets, fixed assets under that. Then non-current investment, it's a long-term investment, isn't it? Then current assets. So this is the balance sheet given. Now let us solve this problem. Let us calculate debt equity ratio. Debt equity ratio. Calculation of debt equity ratio. Page number how much? 123. 123. Problem number 12. Problem number 12. Calculation of debt equity ratio. Debt equity ratio. Debt equity ratio. Write the formula. Debt equity ratio is equal to debt divided by equity. Debt divided by equity. Debt equity ratio is equal to debt divided by equity. DER is equal to debt equity ratio is equal to debt divided by equity. Now write what is debt, isn't it? Debt is equal to long term borrowings. Debt means here long term borrowings plus any other plus other long term liabilities plus other long term liabilities. Other long term liabilities plus long term provisions. Provisions also will come under this. Long term provisions. Long term provisions. Okay? Yes. Then equity means share capital plus reserves and surplus. Share capital. Equity means share capital plus reserves and surplus. Reserves and surplus. So you should know this formula. What is, even if you know this, debt divided by equity, but you should know what is debt, what is equity. If you know this, then it is very easy to solve. Now let us solve the problem. Now here in this problem, long term borrowings, right? Long term borrowings are there. How much it is? 1,50,000, wasn't it? Long term borrowings. Other long term liabilities are not there. Long term provisions are not there. So long term borrowings only is there. 1,50,000. 1,50,000 is equal to debt equity ratio is equal to 1,50,000 divided by equity. Share capital is there, reserves and surplus, no, reserves and surplus is not there, right? Yes, it is there. 4 lakh plus 1 lakh, reserves and surplus 1 lakh, share capital 4 lakh, isn't it? So, divided by 4 lakh plus 1 lakh. Is equal to 1,50,000 divided by 5 lakh. So it will be how much? 0.30 is to 1 is equal to 0.30 is to 1, that is debt equity ratio is equal to 0.30 is to 1. First part is solved, that is debt equity ratio is solved, isn't it? Now moving on to B, proprietary ratio. Proprietary ratio. Proprietary ratio is equal to, I'll write here proprietary ratio PR. PR is equal to formula is shareholders funds divided by capital employed. Shareholders funds divided by capital employed. Here nothing to explain, friends, because all these are balance sheet items, you know it very well, right? So from there only you have to pick, that's all. Shareholders funds, I'll write here, that is SF, shareholders funds, isn't it? Here capital employed, I will write here in short form, then I will use here short form, right? Shareholders funds is equal to share capital plus reserves and surplus. Share capital plus reserves and surplus. Reserves and surplus. Now, share capital is, it is there 4 lakh and reserves and surplus is 1 lakh, right? 4 lakh plus 1 lakh, so 5 lakh is equal to rupees 5 lakh. One part is known to us now, shareholders funds, isn't it? Now capital employed is equal to what will take? Total assets, isn't it? Total assets. Is that correct? Share capital plus reserves and surplus, shareholders funds, then capital employed, we will take, yes, other than current liability, we will take the other part because that is the amount invested, borrowed fund and owned funds. That is shareholders funds is utilized in the business, that is internal fund, isn't it? And borrowed fund, that is borrowed externally, that is long term borrowings, correct? Short term borrowings are not there, current liabilities it is, but it will not come. That is, so capital employed is equal to how much? Yes, capital employed including your this current liabilities. Capital employed means total amount invested, that is total of assets or total of liabilities. Total of assets and total of liabilities is nothing but capital employed. So what we have to do is here capital employed is equal to total assets, isn't it, or total liabilities, because total assets is equal to total liabilities. Am I correct? So we have already calculated, it is given in the problem. Total assets is how much it is? 7 lakh. Very simple. 7 lakh. 7 lakh, isn't it? Yes. 7 lakh. Now come here and substitute the figures. Therefore proprietary ratio is equal to how much? 5 lakh divided by how much? 7 lakh. How much it comes is equal to, therefore proprietary ratio is equal to cancel the zeros, isn't it? Yes, this also cancel. Sevens 0.71 0.71, is that correct? Yes, 0.71 is to 1. 0.71 is to 1. That is what the proprietary ratio is. Proprietary ratio is 0.71 is to 1. 5 lakh divided by 7 lakh. 7 lakh is the total capital employed. Total capital employed in the sense the total of assets or total of liabilities, both remain same, right? Both are one and the same. Always the total of assets equal to total of liabilities. So both are one and the same. You have to simply enter, that is the total assets as your capital employed, and here we have calculated shareholders funds, that is share capital plus reserves and surplus. That is what we did. Yes. Now third one, point C, isn't it? We have to calculate now. I will erase this. What did they ask further? What to calculate? They told us to calculate debt to capital employed ratio. Debt to capital employed ratio. Employed ratio. Debt to capital employed ratio. Here what is the formula to calculate debt to capital employed ratio? Total debts divided by total assets. Total debt divided by total assets. Total assets or capital employed, right? Yes. Or total liabilities also you can take. Same figure it will be. Same figure. So here debt to capital employed ratio. Debt to capital employed ratio. Isn't it? So debt to capital employed ratio is equal to total debt divided by total assets. Total debt in the sense that is long term borrowings plus current liabilities. Long term borrowings plus current liabilities, because short term liabilities and long term liabilities both are both are called debt. One is short term debt and one is long term debt, isn't it? Short term loans comes under current liability and long term borrowings comes under, that is long term debt. But shareholders fund will not come because it is the owner's fund. It is equity, isn't it? It is equity, and reserves and surplus it will not come because it belongs to shareholders. So here long term borrowings plus current liabilities, total debts in the sense long term borrowings long term borrowings, isn't it, plus current liabilities, So substitute here, therefore DCER, debt to capital employed ratio, is equal to total debt. How much it is? 1,50,000 plus 50,000, am I correct? 1,50,000 plus 50,000, yes it is. $50,000 is current liabilities divided by total assets, that's 7 lakh, is it correct? 7 lakh. Therefore, DCER is equal to, divide it and find out how much it is, debt to capital employed ratio is equal to 0.23:1. Yes, it comes to 0.29:1. 0.29:1, isn't it? Yes. Debt divided by capital employed. Capital employed here 7 lakh. Debt here is the total debts. So this is how you have to solve a problem. This may be asked for 12 marks, but when they ask you for 12 marks, they will not restrict to 3. They will take minimum 4, or most of the times they will give 6 ratios to calculate for 12 marks. Because you have to see the time and content also, isn't it? For that reason, they will ask you at least 6 ratios, 6 or 4, not 5 or something like that. They will not ask, or they have to distribute the marks accordingly, isn't it? That's very crucial one. Yes, let us move on now. Yes, now I will take up problem number 13, right? Let us read the problem. In the meantime, I will analyze and we will solve the problem, okay? Yes. Problem number 13. Problem number 13 of your question bank. We solve one problem under each method, that is enough actually. But I want to solve most of the problems of your question bank, so that if the same problem repeats, then you will be in a position to comfortably you can solve that problem, right? Instead of thinking and wasting your time in the examination hall. Better if we practice all the these types of problems, then you will be better in the examination. Problem without any hesitation. That is what my thinking is. Problem number 13. Yes. Let me read out the problem. Compute debt to equity ratio and proprietary ratio from the following. Paid up share capital, net sales, current liabilities, average inventory. Then on the asset side, current assets, 13% debentures, cost of goods sold. Cost of goods sold, is it required for us? Not required, I think. Average inventory also not required. Then net sales also, I think it is not required. Let us see what is required for us. First of all, we have to calculate debt to equity ratio. You know the formula, already you have solved the problem on that, right? Debt equity ratio is debt divided by equity, long term debt divided by shareholders funds is the formula. So you should know the formula, remember that is very important. Calculation of ratios, calculation of ratios. Under that, first one, debt equity ratio, debt equity ratio, debt equity ratio. Yes. Long term debt divided by shareholders funds. Long term debt, long term debt divided by shareholders funds. That is long term debt shareholders funds, right? This is debt equity ratio. DER is equal to, debt equity ratio is equal to, I wrote the formula, isn't it? Now, see which are the items that are required for us. Shareholders funds, here capital employed, no, I'm sorry, long term debt, it is given in the problem. Long term debt how much? Which is the long term debt here? 13% debentures, right? 13% debentures is the long term debt, no other long term liabilities here. So 13% debentures, 2 lakh is the long term debt. Long term debt, that is 13% debentures. For your information, I'm writing it long term debt, right? Then shareholders funds, it is given equity share capital, paid up share capital 5 lakh, and shareholders fund, that is paid up share capital, paid up share capital, share capital. So therefore DER is equal to how much? DER is equal to 2 lakh divided by 5 lakh. 2 lakh divided by 5 lakh is equal to how much? 0.40 is to 1, right? 0.40 is to 1. This is what the ratio is. Therefore, DER is equal to 0.40 is to 1 is the answer. Yes. Now, let me move on. They asked you to find out proprietary ratio, right? So let us calculate proprietary ratio. Proprietary ratio. PR is equal to, proprietary ratio is equal to shareholders funds divided by capital employed. Shareholders funds divided by capital employed. Capital employed. Capital employed. That is long term debt plus shareholders funds. Long term debt plus shareholders funds, isn't it? How to calculate, that is capital employed here. Shareholders funds we can calculate, it is given in the problem, right? Shareholders funds, paid up share capital is given, but what about that is capital employed? How will you calculate capital employed? Capital employed is either the total of assets or total of liabilities. Am I correct? Now, total of assets. What are the assets given in the problem? Sales. No, it is a statement of profit and loss. Paid up share capital liability. Current liability. Average inventory. Inventory comes under stock. Am I correct? Inventory means stock, not comes under. Inventory means stock. So, inventory is an asset, current asset. Then current assets are given other than inventory, 4 lakh. Here, average inventory is given 1,50,000. Isn't it? So, how will you calculate? Then 13% debentures liability, cost of goods sold, it comes under what? Cost of goods sold in statement of profit and loss, not in balance sheet. So, how will you calculate this? Total assets or total liabilities. Let us take up total liabilities. Long term borrowings are there, debentures 2 lakh, right? Yes. Then share capital is there 5 lakh. So, that is also comes on the liabilities side. 2 liabilities over long term borrowings over share capital over shareholders funds and long term borrowings both have taken up. Current liabilities are also given 2,80,000. So, why don't we add these three so that it will become the total liabilities, right? Very simple. See, share capital, first item, long term borrowings, that is debentures, current liabilities, that is current liability given. So, all others are related to assets and statement of profit and loss. So, only these three items, add these three items together, that is nothing but the total capital employed. Very simple. That will be equal to the total assets. So, here write capital employed is equal to share capital plus long term borrowings plus what? Current liabilities. Current liabilities. Right here, share capital, how much it is? Share capital 5 lakh. Follow me properly. Plus long term borrowings are there, that is debentures, 13% debentures 2 lakh, right? Plus current liabilities, how much it is? 2,80,000. 2,80,000. Together it will be rupees 9,80,000. Is that correct? 9,80,000. This is capital employed. This is capital employed, CE, capital employed. So, here substitute the figures. Proprietary ratio is equal to shareholders funds. There are no reserves and surplus, only share capital is there. So, 5 lakh, am I correct? 5 lakh divided by total of that 9,80,000 is equal to, therefore, PR is equal to, proprietary ratio is equal to how much? 0.51 is to 1. 0.51 is to 1. This is how you have to solve. Clear? Is that clear? Yes. Proprietary ratio is over. Now, let us move on to anything else. Yes, that's all, right? Yes. Only two ratios are asked, debt equity ratio and proprietary ratio. So we have solved it. Our problem gets solved. Now let us move on to next problem, that is problem number 14. Problem number 14, right? Yes. Let us solve that problem. I'll read out the problem. In the meantime, we will analyze and then we will solve it. Problem number 14, page number 124. 124. Following information is given by a company from its books of accounts as on March 31st, 2018. Calculate debt equity ratio, interest coverage ratio and debt to capital employed ratio. So let us calculate this. Inventory is given, total current assets, shareholders funds, 13% debentures, then current liabilities, net profit before tax, cost of revenue from operations, total assets, right? Yes, let us solve it. Yes. Let us calculate first this problem number 14. That is debt equity ratio. Debt equity ratio. Point A. Here within bracket debt equity DER, isn't it? DER is equal to, write the formula first, because for formula they will give you 1 mark. For not writing formula they will deduct 1 mark. Remember this. Debt equity. But remember, if you simply write the formula without solving the problem, then you will not get even a single mark. Remember, that is also there. If you fail to write, then they will deduct 1 mark. If you write only formula without solving the problem, then they will not give you even a single mark. Remember this. Debt equity ratio is equal to debt divided by equity, right? Debt divided by equity. You know what is debt. I have already gave this point to you, isn't it? This part is already given to you, debt, where debt is 13% debentures only, 3 lakh, isn't it? Is equal to debt. Here, let us write debt is equal to 13% debentures. Nothing else, only one item. Isn't it? Yes. Then what else? Equity, shareholders funds, very clearly given, 4 lakh. Equity means shareholders funds. Shareholders funds. Shareholders funds, isn't it? That is what we have to do. Equity. Debt is 3 lakh divided by 4 lakh. 4 lakh is equal to, how much it is? 0.75 is to 1. Is to 1. Very simple, isn't it? Then second one, they asked us to calculate interest coverage ratio. Point B, interest coverage ratio. Coverage ratio. interest coverage ratio, that is ICR, right? Interest coverage ratio. That is a formula. Interest coverage ratio is equal to net profit before interest and tax. Net profit before interest and tax. Interest and tax divided by interest on long term debts. Interest on long term debts. Long term debts. Long term debt. Isn't it? Is equal to, how you have to calculate this? Whatever is given in the problem, refer friends. Net profit before tax it is given. Net profit before tax is given, right? So net profit before tax means after charging interest. Interest is already deducted, right? How much is the interest obligation on long term debt? It is not mentioned in the problem. Indirectly it is given. Just see 13% debentures. So 13% means what is the value of debentures? 3 lakh. 13% into 3 lakh. It comes to how much? 13% of 3 lakh comes to 39,000. 39,000. So if you add back this, that is a 13% interest to net profit before tax, you will get net profit before interest and tax. Am I correct? Now whatever is given, net profit given is after charging the interest, after deducting the interest. But if we add that interest to the net profit before tax, then we will get net profit before interest and tax. Am I correct? That is what you have to do here. So net profit before tax, how much? 3,51,000. Am I correct? 3,51,000. Add interest. How much? 3 lakh. That is long term borrowings. 13% interest is given on debentures. So 39,000. If you add it together, then it will become 3,90,000. Am I correct? 3,90,000. This is net profit before interest and tax. Net profit before interest and tax is equal to 3,90,000. Isn't it? So net profit before interest and tax, that is what is required for us to calculate interest coverage ratio. We got it, we have already calculated. So write straight away here, ICR, interest coverage ratio, is equal to, that is 3,90,000. 90,000 divided by interest on long term debt, that is 39,000. We have already calculated, that is 13% on 3 lakh. Correct? Now calculate, that will be how much? Coverage ratio, it is 10 times. 10 times, not 10:1. It is coverage ratio. So it is 10 times it covers. Interest covers the principal amount with the 10 times, right? So that is what the interest coverage ratio is. Last, that is ratio we have to calculate is what? Is it over? They told us to calculate debt equity ratio, we have calculated interest coverage ratio, then debt to capital employed ratio. Debt to capital employed ratio. How much is the debt? Now let us write the formula for that. Debt to capital employed ratio, right? Capital employed ratio, yes. Right here, debt to capital employed ratio, capital employed ratio is equal to, that is debt to capital employed ratio, DCER. Right here, DCER is equal to debt divided by capital employed, isn't it? Capital employed. So here capital employed, how much is the capital employed? That is total of assets, total current assets, then fixed assets are given. See, better shareholders funds are there, then we have long term debt, 13% debentures, current liability, add it together, that is total capital employed. Am I correct? Yes. How much it is? Shareholders funds 4 lakh, debentures 3 lakh, 7 lakh, plus current liabilities 1 lakh, that is 8 lakh, correct? 8 lakh. 8 lakh is the capital employed. So I will write here capital employed is equal to that is shareholders funds plus 13% debentures plus current liabilities, right? So if you take it together, that will be 4 lakh plus 3 lakh plus 1 lakh. So right here 4 lakh plus 3 lakh plus 1 lakh. 1 lakh. Together it will be rupees 8 lakh. 8 lakh. Yes. Now, what is the debt? How much is the debt? 13% debentures. Are there any other debt? That is current liability also comes under that. Is it? But current liability should not be taken as we need long-term debt only. Long-term debt only 3 lakh. 3 lakh. Debt is 3 lakh. So, therefore, DCER is equal to 3 lakh divided by 8 lakh. 8 lakh. Therefore, DCER is equal to much 0.37. Make it as 38, 0.38, is it? Yes, 0.38 is to 1. 0.38 is to 1. This is debt to capital employed ratio. Therefore, DCER or debt to capital employed ratio is equal to 0.38 is to 1. That is what this is how we have to solve problems. If there are more number of ratios, very easy to calculate. Only the thing is that you should remember the formula and you should know what to take whenever some item is there. Interest on long term debts means what you should take, net profit before interest and tax, what you should take, that you should know. If you know it very well, then easily you can solve the problem and you can score full, right? Yes. With this I will stop here and I will take up next problem, problem number 15 in the next class. Okay. Take down assignment. Solve this problem, problem number 14. Problem number 14 and submit your assignment on time. Thank you for watching this video. Thank you.
Don't forget to like our video and subscribe our YouTube channel for all the updates.